Is the mamaearth magic fading away? If you had subscribed to mamaearth's parent company Honasa Consumers IPO, you would be trading in losses at the moment. The stock is down 21% from its listing price, and the Q2 results have just made the company's fortunes look bleak. So, is it the right time to pull the plug from your investments in Honasa, or will the company stage a comeback? Well, that's something that your financial advisor will have to answer, but let me break down the key metrics of the company, its performance and more for you. Well, for investors, Honasa's struggles have translated into significant losses. The stock is down about 30% in the past month and nearly 51% from its 52-week high. On its stock market debut, Honasa shares got listed at 330 rupees, but right now the share price is hovering around 260. During its IPO, its valuation was pegged at 10,000 odd crores, but today its market cap is hovering around 8,500 crores. But what's not working? Let's start with the numbers. Honasa's financial journey has been a roller coaster. In FY21, it was struggling with massive losses of 1,332 crores. By FY24, things turned around in a major way as it managed to log a profit of 110 odd crores. And now, Honasa's Q2 FY25 performance paints a worrying picture. The company reported operating revenues of 462 crore, down significantly from 554 crore in the previous quarter. Even more concerning, it slipped into a 19 crore loss compared to a 29 crore profit year on year. Now, what's dulling Honasa's glow? A major factor is Project Neeve, an initiative designed to streamline their inventory and expand offline distribution. Project Neeve was expected to help the company transition from a super stockist model to direct distributors in their top 50 cities. So far, the company has completed the transition in 70% of these cities. However, the restructuring has contributed to operational disruptions and an inventory overhang. This has put immediate pressure on both the top line as well as bottom line. Adding to the challenge is the rising competition in the online beauty space and a slowdown in the booming quick commerce segment for Honasa, which had been a significant growth driver for the company. The company had initially estimated that this would have an impact of around 150 basis points due to the process of right-sizing the inventory. However, the number was much higher by the time the project neared completion. The company ended up taking 63 crore hit in its Q2 FY25 revenue alone due to the inventory correction. Honasa's offline strategy is another key focus area. Its offline channel contribution rose from 9% in FY20 to 35% in FY24. While this growth looks impressive, the restructuring hasn't been smooth. Inventory takebacks and an increased dependency on offline channels have come with their own set of costs and execution risks. Importantly, the management itself has admitted that the strategy that got them to 1,000 crore isn't enough to take them further. That is why these structural changes are important. The company itself is positive. It hopes to return to growth within the next few quarters. But at what cost? Critics argue that Honasa's challenges go beyond mere inventory or distribution. Key issues include a product lineup and design that haven't evolved fast enough, a marketing strategy heavily reliant on influencer campaigns which may not be yielding the same returns as before, and suboptimal investment allocation across categories, leaving certain segments underdeveloped. In short, the strategy to scale beyond 1,000 crore hasn't delivered as planned so far. And the story doesn't end here. Media reports suggest that distributors are grappling with unsold inventory nearing expiry, a consequence of Honasa's inventory correction. However, Honasa clarified in an exchange filing that the total inventory across its distribution network amounts to 40 odd crores, refuting the All India Consumer Product Distributors Federation's allegation of 300 crore worth of near expiry inventory. The company also disclosed that it has already processed returns worth 41 crore out of the total 63 crore of anticipated returns. Other concerns include sales having been affected by subdued demand driven by evolving consumer preferences and shifts in consumption patterns. What do experts have to say about Honasa's stock performance? Well, brokerages have expressed their concern with Citi actually downgrading Honasa to sell from buy. It has also reduced its target price to 300 from 540 earlier and lowered the FY 25 to 27 revenue estimates by 9 to 16%. Another brokerage, MK, has also downgraded the stock to sell from buy. It has also cut the target price to 300 from 600 earlier, and it noted that recouping the losses in the long term would be daunting. MK added that it awaits proof of execution of the management steps to effect a turnaround. Well, in terms of valuation, the stock is trading at a trailing PE of 74 times, down from 112 times in FY24. As per Bloomberg, out of 12 analysts tracking the company, 6 suggest buy, 2 say hold, and 4 are recommending a sell. So, as Honasa navigates its growing pains, a few questions remain critical. First, should mamaearth focus on being a predominantly online brand rather than stretching into offline channels? Second, does the management lack experience and expertise in handling offline trade? Third, will the direct distributor model be enough to restore growth? Well, now that you know, what are your views on the stock? Also, what are other companies that you want us to analyze next? Let us know in the comments below and stay tuned to NDTV Profit.